don't agree with them. For us here at Phil's Gang, we make it so it's simple. It doesn't matter if the market's bad or good. We consistently do well because we make it simple. And just like for my listeners on the radio or on the internet or my podcast, we make it simple. We try to break it down so you really understand why the market is going up or why there's continued inflation or why the bank rates are going up. So you understand, especially yields. The most important thing to understand how yields work. Just what we do. We work hard at it.
Trusted advice, easy to understand strategies that will make you a better investor. Get all the details at philsgang.com. That's philsgang.com.
Whoa.
Now, here's Phil.
Debt everywhere. That's right. It's interesting. Last Wednesday, the big celebration, the big 600-point rally, there's no end to the stock market rally. They cut rates again, 25 basis points. Everybody was celebrating. And then Powell's announcing he's going to start printing, have the Treasury print, give it to him. $40 billion a month to buy more treasuries, just like they did with QE during the dot-com. It's getting insane. So the debt expansion is problematic. First of all, because the way they're funding all this debt, including the national debt, it keeps going up, and corporate debt deficits, forcing all the yields to go up. And the real problem is the corporate debt is the AI companies. They're borrowing like crazy. They're borrowing now more than during the dot-com crash. Can you believe that? And Oracle, for example, they're spending $12 billion just in one quarter, for their data centers. Credit markets are flashing red warning signs all through the industry. The amount of money that is being borrowed is incredible. Now, I talked about this morning with my gang members, pointing out to them that what has really gotten nuts is they weren't truthful last Wednesday when they announced the rate cut, and the markets, everybody celebrated and jumped in, and the market went up 600 points. But they didn't give them the information. That would have never happened if they told them the truth. They didn't give them the correct information. Sure, we had a 25 rate cut. Are you kidding? What are you, nuts? That's just more inflation. And the other problem is not only all the funding for AI, but our debt and deficits and corporate debt, historic debt there, keeps on climbing, which automatically pushes up our yields, interest. And Wall Street's very concerned about that. They're very concerned about how they're funding all this debt. Not only the corporate debt, but all this AI debt. And the national debt deficits, all with short-term debt T-bills. So we got so much debt on its own is automatically pushing up our yields. Think of it as interest rates. Monday, with the celebration of the 25-point cut and the borrowing, printing of 40 billion a month, printing, that's inflationary. 40 billion a month to try to buy 10-year treasuries and hoping to force those 10-year yields down so that they can get car payments down and mortgage payments down and business loan payments down, because right now we have a big problem. I mean, if you just look at what's going on with all this debt, it's just amazing. Let me give you some examples of what's going on. First of all, as I said, if you look at all the AI companies and look at Oracle, what we're seeing is all that debt is being funded with T-bills. Trump is funding all the national debt and deficits with short-term T-bills. You can't do that because T-bills, if you get a 1-month T-bill, 2 months, 3 months, 4 months, you got to keep rolling them over. And they're known, the dark corner about T-bills, and you probably experienced it, when they roll over, if you have a month T-bill or you have a 3-month T-bill and they roll over, they can spike big. That means your interest goes up big. All this borrowing the tech companies are doing could go up big. So that's a real problem. So Trump has been funding all his debt with the short-term T-bills, which he has no choice because we can't get China, Japan, and the UK to jump in and loan us money 10, 20, 30 years. They're taking that money and buying silver and gold. And as I said, the big nasty problem with those short-term T-bills, you can wake up the next morning and the interest rate going through the roof. The other problem we're having is that the debt that everybody says is no problem at the banks, the $600 billion debt at the banks. They say, oh, that's fake. Doesn't matter. That really grinds me when I hear that. It's not fake. If it was fake, it wouldn't be on the balance sheet. The debt is on the balance sheet. It's certified by the accountants. It's on the balance sheet. The truth is how they're handling the debt. So what they're doing with the debt, as long as the deposits at the bank are healthy, then the reserves that we have at the banks that are mandatory for emergencies and bad debt will hold their peak. So as long as you got enough money coming in, enough deposits, then all this debt, the $600 billion of debt that is classified now as unrealized, will be fine. But it's not fake, it's on the balance sheet. If it wasn't on the balance sheet, then I tell you it's fake. You don't have to worry about it, but you got to worry about it. Wall Street's worried about it. So all these losses, every time now, people are going to their bank and removing their savings, taking money out of the bank and buying these very attractive T-bills for 1 month, 2 months, 3 months. And Trump is pushing the T-bills because he can't get 10, 20, 30-year money. So he's pushing the T-bills. So what has happened? The bank reserves have dropped from $4 trillion to $2.5 trillion. So don't tell me this is fake. The $600 billion is fake. It's not fake. It's on the balance sheet. People misunderstand what's going on because they listen to jibber jabbers on TV. They don't know what the hell they're doing. They get a cue card, they got to read it. This is very serious. We have dropped that big from $4 trillion to $2.5 trillion. That means any moment they can turn around and take this debt, this unrealized debt that they classify, as long as you have good deposits, and as long as your reserves, if you're supposed to have reserves at, say, $10 million, as long as they stay at 10 million, but that's not what's happening. The reserves have dropped, as I said, from 4 trillion down to 2.5 trillion, because at the rate money is being pulled out of the banks to purchase the short-term rates that Trump is pushing on these T-bills. So that is a powder keg ready to explode. So the next time you hear people, he doesn't know what he's talking about, that's just, it's all fake. It's not fake. If they say that to you, asking them, why is it on the balance sheet? So you're telling me the biggest accounting firms in the country for these biggest banks in the country, why do they have it on the balance sheet? Why would they put it there? They're the brightest, the best. Why do they even put it there? Because it's real. The other thing that's going on is the cost of automobiles, the cost of homes. So we have a tremendous affordability gap in this country.
5 minutes.
But what are we told? Let's see, do the cut where the president was talking about the affordability, how everything's great again.
We're bringing those prices down rapidly, lower prices, bigger paychecks. You're getting lower prices, bigger paychecks. We're getting inflation, we're crushing it. And you're getting much higher wages. I mean, the only thing that's really going up big, it's called the stock market and your 401ks.
All right, we talked about this last week. Then why did they come out this week with the affordability gap, not only in housing, which is historic, the gap's at 57%, meaning if you went to buy a home today, it's an average of $462,000, you got to pay a payment of $3,600 a month, you need income of $125,000, and therefore we have a gap of 57%. Auto, this just came out, auto affordability gap. Main Street is now borrowing record amount to afford a car. Well, if our wages are going up and our inflation isn't, and prices aren't, then why is it that Main Street is now borrowing record amount of money to afford a car? A new car is now $50,000. What are you, absolutely nuts? An average new car loan is up a record $41,000. Here we go, the affordability gap. This is unbelievable. Mortgage rates have increased 176%. Payments are up 141%. So again, when we hear how wages, everything is doing terrific, in some cases, President Trump is correct, but not Main Street. Not Main Street. Rising yields are killing us with our national debt and our deficits. We have too much debt. So we got to get these yields. They got to cut debt. They got to go in and cut debt. The problem is they're not cutting debt. We just have too much. And we're financing it wrong. You can't finance this kind of debt with short-term 30 days, 60 days, 90-day debt, and you got to turn it over. It's just crazy. It doesn't work. So these T-bills are becoming so popular, I said a moment ago, very popular. Everybody wants T-bills now, because look at the people are making more money on T-bills than they're making on stocks. Especially, even if they're making more on stock, people are jumping into the T-bills because there's no risk. That's what they perceive, there's no risk, there's always risk. So I want you just to think about this. Everybody is saying not to worry about the unrealized losses. Well, how come they didn't say that in March of 2023 with Silicon Valley Bank, First Republic Bank, Signature Bank, March of 2023? Why didn't they say, oh, don't worry about it? They all got crushed. Why? Because the debt keeps on going up. The yields keep on going up. And when the yields go up, the reserves come down, and those banks, Silicon Valley, First Republic, Signature, had unrealized losses just like now. Nobody talked about it. They couldn't keep them unrealized. They had to be switched to a category of realized. Because why? Because, again, everybody were buying short-term debt. And so the reserves dropped on these three banks, and they exploded. Why are we going to be so lucky to think it's not going to happen with the biggest banks today? It's going to. So what do you got to do? Well, it's wonderful that we are having rotation out of tech into these other areas. I go over with you when we come back. We're having a wonderful rotation. But why was it on Wednesday our yields went down, but on Wednesday they went up? Who made that call? More when I get back.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
When the stock market is volatile, how do you invest intelligently?
Hi, I'm Phil Grande at philsgang.com. There's no need for you to be panicking in a market that goes up 800 points one day, 700 points, then it goes down again. All you need is good advice, need good direction. You don't get that from your CNBC and the Fox Business and all these crazy shows. You don't. Here's what you get from them. Thank you, Jim Cramer. But this is something that this really bugs me. Listen to this.
Our responsibility begins and ends with our partners and our shareholders, and that's it.
What? Their responsibility is to their partners and shareholders and not to you? Check my site out, philsgang.com.
When the stock market is up one day and down the next, you need the experience of Phil Grande at philsgang.com.
What a difference it makes in your financial life. philsgang.com. It works.
Welcome back. Learn, invest, and make profits with Phil Grande. Simply go to philsgang.com. Now, here's Phil.
And welcome back. So here we are. We got thrown a curveball on last Wednesday. Oh boy, everything's great. We're cutting rates by a quarter point. We're going to start printing money. We're going to start buying treasuries. All the yields are going to start dropping. Car payments, mortgage payments, business loans, all going to come down. Instead, they reversed and went the other way, which we knew. I told you that was going to happen. I told my gang anyways that was going to happen. And I said it many times on my podcast. I said, you watch. They're wrong. Because where we stand today is worse than where we were September 17, 2024. We have the same problems, but worse. They're multiplied. Now listen to this when they tell us this stuff.
There's been much said about factors that are potentially decreasing employment, like artificial intelligence. We don't actually see that in the numbers yet. And for the most part, the employment picture is very good.
Oh, really? Okay, we have 170 million people working. Only, I think, 17 million of that is AI. I'm not worried about AI right now. What I'm worried about AI is the amount of money they are borrowing is insane, is crazy. Oracle borrowed, for example, $12 billion in 1 quarter. Credit markets are flashing warning signs. And listen what they tell us, though.
So the story out of the banking industry is that credit continues to.
Sorry about that. See if we can get that, rack that back up.
Give it a second.
Let's try it again.
Play it again.
So the story out of the banking industry is that credit continues to remain very solid.
That's a bold-faced lie. It's just a bold-faced lie, but this is what they do. So that's why when you're trading stocks, don't listen to any of this stuff. Follow the money. Learn how to sell short. As long as you're buying stocks, you should not be in the stock market unless you know how to go long, buy a stock, and go short. Because the only people who make money in this industry are people who buy and sell short. Because they totally don't give a damn about the economy. They don't care about this stuff. They care about one thing, following the money. And when you have unbelievable debt surging, deficit surging, historic corporate debt surging, it doesn't matter. That means at some point, I'm going to use my shorting skills. 90%, 93% of people lose money in this business. 93%, because they don't short. They don't want to short. They're scared to short. Shorting's not hard, very easy. I always say this, and I'm going to say it again. The thing that really makes me angry is when you have a stock. Let's say the stock is at $50 if you can find one today, $50, and it's got a buy signal on it. It goes all the way up from $50 up to $100. And you look, it's buy. Now it starts dropping from $100 down to $90, down to $80, down to $70. And you look, and it's still got a buy. Now the stock is down towards 50. It's still a buy. So why did they change the 100? It went from 50 to 100 with all buy recommendations. So why do they keep the buy recommendations to 100 back down to 50? Because they need you to hold the stock market up. They need you to believe you're going to make money if you buy on the dip. They need you. They take parking space in your head so you believe if you cost average down, you're going to be fine. After all, they're saying, look, if you bought the stock at 100, what a wonderful buy you got now that it's 13 cents. Buy on dips. Why do they do that? To get the big institutional money out. And then finally, when the stock went from 50 to 100, and it started to go down to 95 and 40 and 30, people kept buying on a dip. Kept losing more money, keep buying. And then when the stock got back down to 50, what happened? Now the stock market, now they go change it to sell. Wait a minute. So you had the buy recommendation all these months, say 5 months, and the market went down 70%. Now it's at the end, and now you're going to change it from a buy to a sell recommendation? Yeah, why? Because Wall Street got all their best clients out, the Steelworkers Union, the Nurses Union, the Police Union, the California Workers Union. They're out. They made money, a ton of money. They're out. Why? Because of you. You held that stock up buying on a dip when it's going down. So why at the end do they finally change it to a sell when it's gone from 100 down to 50? Now they're going to change the tell. Here's why, because they're going to screw you again. Because what they're going to do is they want you to sell. So they want to make sure, these cowards on Wall Street want to make sure there is no buyers in there at all. Not one buyer. Scare out. If there's 3 buyers in there, scare them out. Now they come back in with their clients that they made a bundle of money, the big institutions, and they start buying when they put the sell recommendation on. Now the stock goes up $50, $60, $70, $80. It's got a sell recommendation, but it's still going up. What happened? Somebody missed the key on the computer? Still going up. Then just as it gets towards the top, what do? They'll change it. They'll change it again to a buy. So on the way back down, it's buy, and you do the same thing to the tourist investor or the FOMOs. Buy on a dip. Keep buying on a dip. Buy on a dip. Cost average down. That's what they do to you. So if you don't have, that's why they have scared you for 100 years. Don't sell short. You're going to go blind. You're going to lose your home. Your firstborn, okay, is going whatever. All lies. Why do you think they don't want you to short? Because they make a fortune on you. These big brokerage houses, J.P. Morgan, Goldman Sachs, Citi, you know them all these banker gangsters. They're not on your side. They make money on big institutions. But it doesn't matter if you know how to short. Why do you let yourself be used? What are you, nuts? That's insane. Did anybody ever wonder why they keep buy recommendations when the stock's going from 50 down to 15 or from 200 down to 15? No, nobody thinks about it. Oh, they must know what they're doing. Now listen to this stuff. If you just follow the money and you have the skill to short as it goes along, you will be making money consistently. Sure, you're going to do some stupid things and you're going to lose money. We all do stupid things. We all lose money. But overall, at the end of each year, we're going to be making money. But if you don't know how to sell short, it's impossible. Now, listen, do you realize you have to trade to perfection? Everything you buy, you got to trade to perfection. And where do you mostly do your buying? With the FOMOs. Right at the peak, fear of missing out. Now listen to this garbage.
There's been much said about factors that are potentially decreasing employment, like artificial intelligence. We don't actually see that in the numbers yet. And for the most part, the employment picture is very good.
Very good. The employment picture is very good. We just lost 1.1 historic million people, million workers. 1.1 million. A record. What are they talking about? What are they talking about? It's good. It's not good. If employment was so good, then why the hell is it that applications are being denied? Applications for mortgages are up 46% denial. 46%. And you want to go refi? To refi your house to get a lower rate? Denials. Rejections up 46%. Get a brand new mortgage. Rejections up 25%. Credit card. I never heard of a bank turning down somebody with a credit card, especially when they have to pay 22, 23% interest. But they are, 21%. So if that's the case, if mortgage applications are down 23%, refis are up 46%, autos finance rejections 15%, what is he talking about? That things are good, the jobs are good.
5 minutes. For high-income and middle-income consumers, their late payments, they've actually dropped 3 of the last...
for the wealthy. Oh, their late payments drop, of course. Oh, but the low, too. Are you kidding me? Are you kidding? That's not even close to being true. But should it upset you? Of course not. Now listen to this.
Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So
now, why don't you just say this? The people who got all the money are spending it. The top 1%. Or you can say the top 10% if you want, but it's the 1%. They have all the money. They're spending it. And that's why the economy's not doing well. If you have the top 10% that has all the spending, you can't grow the economy. You need the rest of the economy, and you need them to be buying big ticket items, furniture, appliances, big screen TVs, big ticket items, which are not being sold. They're not buying that stuff. They're not buying it. When you have a country where people aren't buying big ticket items, and the guy on Main Street can't afford it, you're screwed. And why do you think Trump continues to borrow money short term? He's trying everything he can do to fund this debt we have.
Follow up on your comments about job growth. Why is it so much worse than the official data is suggesting?
Oh, well, we know, I think it's.
Oh, Paul, just say we lie. We lie, that's why. Are you kidding me? Why is it much worse than we report? Because we lie. It's what we do. It's who we are. We always lie to you. That's my job. Why do you think I'm getting fired? No, we always lie. So at the end of the day, when you're trading your stocks and you look like us, where your GDX, you're up about 65%. NVIDIA, you shorted that. You shorted NVIDIA. You're up 22%. You shorted Microsoft. You're up 15%. See, that's where you make money. That's how you make money. So the Qs, you shorted the Qs and say you're up 12%. What's wrong with that? You shorted ARC and you made 10%. What's wrong with that? That's the only way you can make money. And the stocks that you're up, GDX, we're up about 60%. What's wrong with that? You got to be able to do both sides. You got to have the buy side and the sell side. The only people who have the buy side and the sell side in the stock market are the bankster gangsters. It's designed that way.
2 minutes.
It's not designed that way. So it's very clear when you look at the market, what stocks are going up. They're going up for the wrong reasons. Gold's going up. The miners are going up for the wrong reason. The economy's not good. People are fighting countries. All central banks around the world, they know what's going on in the U.S. They know yields are rising. That means when you have the yields that are rising, then they're anticipating interest is going up. They're anticipating Powell is going to take his short term and he's going to have to raise rates with the short-term Fed rate. He's got to fight inflation. Inflation's going up. So this idea that we went down on Wednesday, the Fed rate cut down 25 points, then on Tuesday, everything started to go back up because everyone knows we are going to be raising rates very soon again. This is not working. Why are yields going up? They know. They're buying gold because the reason they know why your yields are rising, caused by too much debt. And when you have too much national debt, too much deficits, too much corporate debt, and look at these people with corporations, they've been paying 0% interest or even 1%. Now they got to pay 5 to 8%. Why do you think they're buying gold? But guess what? There's a gold mine because all these stocks are going to go down. And when they go down, you should be able to short them with the ease as you buy them. 93% of people don't know how to do that. It's pretty sad, isn't it?
Listening to Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.